You cannot go to a transaction saying, my company worth 100. You have to be flexible and you have to have a range.
The entrepreneurs, they think in terms of, I want to sell my business. So some of them are going to say, okay, I want to do an exit. The idea is they want to sell at some point, except they have no clue how that's going to work.
Basically, there are two types of investors. You have a strategic investor and you have the financial investor. What is the difference between the two? Strategic is someone that could be interested in your market, but not only on the financial part of the transaction.
The M&A process, it's actually a way to scale the company that you have and to make it ready for the next step.
One of the main challenges of a startup companies is
Hi guys, welcome back to the Scale Up Show. Today we're going to talk about M&As with Estevão, who's here with me, Estevão Tavares, who's an expert. It's going to be pretty interesting because we have lots of story to talk about. Estevão is based between Spain and Portugal, but he is also Brazilian. Are you Brazilian or are you Brazilian and Portuguese with different nationalities?
Yes, I'm Brazilian, Spanish, in fact.
Okay.
Yes, but I born in Brazil.
Okay, so multicultural guy. Estevão has been around Lisbon for quite a while. He's been advising multinational companies on their expansion plans for a few years, so we're going to talk about how that's working. He's been a financial director at PwC, so big accounting and financial consultancy firm, on variety of topics ranging from oil and gas to agribusiness, sugar, food, wine, spirits, retail, consumer goods, and basically it's been a question of, I like that expression when I did my research, of road shows for equity funding. We have to talk about that, it's pretty exciting. But basically between Brazil, Europe, the US, even China.
Yeah,
I like the China part.
Yes.
We're going to talk about that as well. We like numbers every once in a while, and you mentioned that you've been working on $1.7 billion in transactions total. You're also a partner at CPWM Wealth, which is going to be rebranded as the Wealth Alchemists. We can talk about that as well. And you're a startup advisor. Kind of a good summary?
Yeah, that's perfect.
Okay, so that's for today, M&As.
Yes.
So, personal story first. Where do you come from?
Okay.
What's your background?
Okay, first of all, I want to thank you for the invitation.
Sure.
Yes, it's a great pleasure to be here and sharing a bit of my, let's say, knowledge, yes, with your audience. And yeah, I always like to talk, so hope you like. Well, my history is quite simple. I'm a very simple guy. I grew up in Brazil. I born in Brazil. I grew up in Brazil. I started working when I was only 14 years old with my grandpa. And it was a huge experience for me because basically he taught me how to sell. You know, I learned how to sell very young, you know, and then later on I decided to do business administration at the university.
What were you selling at the time with your grandfather?
Insurance.
Oh.
Yeah, insurance.
That's serious.
Yeah, we have a insurance brokerage company in our family still. My brother is running the company, in Brazil. But it was a very nice experience on my side, let's say this way. Later on, I got graduated in business administration in Brazil also. Then I got my MBA. But of course, right after I got graduated, I started working. And my first, let's say, experience was on a mergers and acquisitions boutique, an M&A boutique in the state of Rio de Janeiro, Brazil. 1 year later, then when I started working with them, I was invited to move to São Paulo, and I accepted the challenge to move to São Paulo. And São Paulo is a huge, let's say, city with thousands of opportunities, and a lot of things are happening in São Paulo, Brazil. So it was a very good movement from my side, because I had to learn fast. And then a few years later I was invited to join PwC, and I had a very let's say quick career there, because when I was I think 35 years old only, I became a director there. And this happened basically because most of the projects that I got involved got to a completion phase. It's not that easy to reach the completion phase on a mergers and acquisition process. It's a very challenging, let's say, environment that we have. So,
can we take a moment to explain? So M&A, mergers and acquisitions, sounds like something big. It's always a term that, either you're very excited about it or you're like, oh God, what is this? I don't want to hear about it. It sounds complex, boring, whatever. Yeah. So what's the concept? What's the role of M&As in a company's life? What's the impact for entrepreneurs? And also, is this something that's only happening in big companies, or at the end of the day, is it just a big name and a big concept, but something that also happens to small companies?
Okay. Yeah, it's a good question, an interesting question. I always say that mergers and acquisition is a transaction. Mergers and acquisitions, it's on the name, mergers and acquisitions. So it's, in summary, a transaction. And there are several types of transactions that can occur over time, over the life of a company. When you are on a startup phase, you can do business combination, which is a kind of a merger, right? When you are on a more mature phase and you are looking for growth, you are more with the objective of acquiring competitors or acquiring companies that might have products that could help you grow faster, for example, or build higher entry barriers into your market.
So technically, it's a question of one company doing a transaction of acquiring another one, and then both of them merging.
Yes.
So somehow it should be acquisition and mergers rather than mergers and acquisitions.
Yes.
Yeah?
Yes. But in summary, it's when a transaction occurs, no matter if it is a combination of two operations or one acquiring another one, right? That's it.
Is it always a question of a company mixing with another one, or is it also a company just buying a competitor so that they own the market, but the company remains the company the way it is? So same brand, same everything. Do they have to mix everything? Do they keep things the way they are, or do they even buy a company to kill it, just to make sure the competitor disappears? What can be the configuration?
It really depends on the objective that is established on the beginning of a conversation. For example, if you are the owner of company A and I'm the owner of company B, my objective might be acquiring you to simply get you out of the market. Then, after a transaction is completed, we will work to implement this objective, on the implementation of this objective. Sometimes we, as company owners, we are deciding to combine our operations because we will become stronger after that. So it's not a matter of removing you from the market or myself out of the market. It's a matter of having both of us working together on a more stronger position. So it really depends on the objective that is established on the beginning of a conversation, And this is one of the steps that I think that is crucial for the success of a transaction, because sometimes you see the failure due to the lack of this discussion, when you do not have this kind of discussion, sometimes that's the reason for a failure.
Yeah, because at the end of the day, most companies need to get to their own next step at some point, and they don't necessarily have the opportunity to do it. So thinking in terms of M&A as an entrepreneur is a way to say, who could buy my company? How can I build my company so it can be bought by someone else? And then I can just give them the key. Thank you very much. I'll keep the money. You get the keys. It's a way to keep growing. It's a way to anticipate. It's a way to build the future of your company, right?
Exactly. You touched a very important thing. You have to know what is your desire, what you're looking for. That's the starting point for a transaction to occur. So, and there are several reasons that might be your, inspiration for running a transaction. You can do it for growth purposes. You can do it because you want to retire. Sometimes you do not have a son to take care of your business.
There is no transmission, transmission.
No transmission, yeah. Sometimes you're simply tired. And on this situation, I just recommend you to take some vacation instead of selling, because creating a company is a very good way to create wealth over time. But sometimes you see entrepreneurs tired and they sell. Then they regret later on. Sometimes the reason is you have an increasing competition on your market and you're getting stuck. Your margins are going down, so you have to take action before you fail. There is a failure on your business. So there are plenty of reasons for an entrepreneur to consider a transaction. And it's a matter of having this very clear, a crystal clear view about what is the current situation and take action to have this happening.
It's funny because there is a word you're not using. It's the word exit, and it's a word that you hear a lot from entrepreneurs, as in they start a business. They have no clue how they're going to do it, but their point is, I want to do an exit. And you see a lot of entrepreneurs online. You look at their LinkedIn CV and they go like multi-exit entrepreneurs, as in that's the growl, I've done it and bravo. So the entrepreneurs want to look at the exit. They want to look at how they're going to sell the company. They don't look at it in terms of, I'm going to do M&A, right? But your perspective is the process of it. Your perspective is the how do we make it happen and how do we structure it. And so that's where there is a shift between exit on the one hand and the M&A on the other one.
Yes. How do I see exit? I think exit is a consequence of a good work. If you did your homework, you will become attractive, and naturally the exit is an option that you will have on your hand, and the M&A itself is the process, how you are going to get to the exit, how you are going to implement an exit. That's how I see. So there are a set of steps that you have to go until you get ready for an exit, So that's how I see. I can give you some examples. For example, if you wanna implement an exit, you created a very successful company. How do you get to an exit? Usually, first of all, what are you looking for? What is the kind of transaction that you are looking for? Are you going to sell the whole company? Are you going to sell a portion of the company? If it is a portion, is it a minority portion? Is it a majority portion stake? So all of those questions are really important to be answered prior to an exit, because it will make a lot of difference on the approach that you're going to take with possible investors. So this is one thing. Second, if you are foreseeing an exit, how much are you willing to take or to get after a transaction completion? Did you do your homework, valuing?
Yeah, so I was going
doing
to say
a valuation exercise of your business.
That's bringing the valuation point, and how do you value your company, and how do you build your company so that it gets value?
Exactly. So, and you have to do your homework. You can do your own, let's say, studies to do a kind of a calculation of your valuation metrics, but you can hire the third party to tell you what is the value of your company, right? So setting a range of value is really important. And why a range? Because you cannot go to a transaction saying, my company worth 100. You have to be flexible, and you have to have a range, because for you, my company can worth 120, but for him, the value could be 300. So it really depends. Having a range is really important. Third, how are you going to conduct the conversations? You have to be prepared for those conversations. So you have to have a set of documents to enable the counterparty analyze and define the value of your company.
There was a story you told me when we had one of our first coffees by the beach here in Lisbon. It was that story about a merger and acquisition operation between a Brazilian company and Chinese company. Can you talk about, like, without getting into the details, but giving some examples as to what kind of unexpected BS can happen in that kind of situation?
On this specific situation, we had a very interesting arrangement, because, in fact, it was the dilution of an existing relationship. They were partners. They Brazilians and Chinese, they created a company a few years ago. Then they decided that the Chinese would like to take over 100% of the shares. So we were working, helping the Brazilians to sell the shares to the Chinese. And then we kind of agreed on a range of value, and we went to China to, let's say, close the deal after several months of negotiations.
Except things didn't really happen like that.
Yeah, exactly. Never. And then when we landed in Guangzhou, close to Hong Kong, and then we had the meeting, and then the first discussion was about finishing the discussion of the value, and then the Chinese dropped the value dramatically. The range was not observed anymore by the Chinese.
So something like, we said it's going to be 10, but in the end, no, sorry, it's 3.
Exactly.
Okay.
Something like this. And then on this specific situation, of course, the client got really mad with that situation, because we flew 23 hours from São Paulo to Guangzhou, and then we got this information. Was really stressing situation. Then we simply went to a separated room to discuss the outcome of this. The client was really mad, and I was quiet. And then the client asked me, "What is your opinion, Estevão? You are not saying anything." Then I told him, "Look, I read this contract, every word here. You have the option to remove him from the business if you want. So it's a matter of you to decide if you want to execute this right or not. And of course, you have to communicate this to them. What I would like to suggest is make sure that you have a different supplier in hand to do that. Because if you do that, they will not be your supplier anymore. Then the client said, "Are you sure about that? Can we call the lawyer to make sure that this is doable?" And then we called the lawyer confirmed, and we went back to the table, and we told them about our decision. We closed our computers and we went out. We quit the meeting, saying, "No deal anymore. We are out of this." So sometimes, depending on the tools, depending on the details and what you have in hand, you can unlock a lot of value out of a negotiation. On this situation, they were able to sustain a much higher value, because when the Chinese realized that they were about to lose their position through a buyout mechanism, they had to step back. And, So if we go back to the point I was making, the entrepreneurs, they think in terms of, I want to sell my business. So some of them are going to say, okay, I want to do an exit, right? Some say, I'm tired. I want to sell that company and move on. I need to play golf, right? So it depends on the motivation, but the idea is they want to sell at some point. Except they have no clue how that's going to work. And the best way to actually make it happen is to switch from a selling / exit sexy mindset to let's get into the details. Yes. Let's do the due diligence. Let's look at how we're going to do it, who we're talking to. Let's get support from the right lawyer. Let's get support from the right finance guy who can be the intermediary. And when we have no clue about how this is going to happen, they can do the job. That's the point. Yes. If I would if I would give a recommendation, is plan a structured process. I was mentioning the steps. Know what you want. Set up a range of value. Decide about what kind of transaction you're looking for. What kind of investors are you looking for? Because basically there are two types of investors. You have a strategic investor and you have the financial investor. What is the difference between the two? Strategic is someone that could be interested in your market, but not only on the financial part of the transaction. Also on the market positioning and the market share. A company that is not exactly a competitor, but might be interested on your market. This is a strategic investor. These are the strategic investors. But for example, if you want to talk to a financial investors like a private equity firm, a venture capitalist, a fund, this is a completely different approach. These guys are willing to have companies with a very interesting growth perspective, because they are looking more into the returns, So growth is really important. So defining this, having a structured process helps you to plan all of those steps in advance, and also prepare proper documentation, have a data room with all your documents, because this is also really important. I see a lot of entrepreneurs or even company owners with successful businesses, and when they realize they want to sell, it's a mess. It's a mess. They don't have a balance sheet ready. If you ask for a balance sheet, it takes 1 week for getting a balance sheet, and should be ready if you press a button. It's also, and tell me if I'm wrong, but in my experience as a scale facilitator,
We see companies where the organization is messy, right? And in the end, we've seen deals just go away because the company was a black box. And the best way we found to explain to the entrepreneur why that went south was to say, okay, would you put your hand in a black box, as in you don't know what's in there, and I'm telling you maybe there is the key to that big house at the back, but maybe there is something you don't like as well. If you dare putting your hand in that box, maybe you get the key. Will you do it? It can be really nasty stuff in that box, you know? Do you want to take the risk? And the investors, they don't take that risk because they are risk averse. They take risk because they can control that risk, right? And we've seen that with entrepreneurs who can have international structures and companies everywhere, but no rational legal structure that can govern all that. And so they can have a business that's working very well in different places, but they can't sell it just because they have the wrong structure.
Yeah. Yeah, I totally agree with you. You know, I had an experience selling an auto parts company to a Japanese listed company in Brazil. And you know, to become an auto parts producer, you have to be very efficient because you are dealing, your clients are the big multinational car manufacturers, you know, and the margins are very tiny. So you have to be efficient. You have to control everything properly. On this specific situation, I always say that the success of such transaction was mainly due to the fact that they had the company in hand. They were able to press a button and have their income statement, balance sheet, anytime we want. So when the Japanese came to acquire this company, they felt very comfortable because the numbers were reliable. They were audited. So yes, it helps a lot when you pay attention to this as an entrepreneur or as a company owner. Sometimes I refuse some jobs when I see that this is not in place yet. You know, sometimes you have to step back and help the entrepreneur or help the company owners to organize, to prepare. Let's say, do the homework prior to a transaction, you know.
So it's interesting because usually the thing I hear is, oh no, you know, M&A, I'm not there. It's for big companies only. And so there is that idea that the M&A topic is just unreachable for most entrepreneurs, just if you're listed or if you're a multinational big company with tons of money and lawyers and accountants and you press the button and you get it, right? But the way you're presenting things is thinking about the M&A process is a way to help you scale your company. So it's not M&A is for scale-up companies that are already scaled up. It's actually a way to scale the company that you have and to make it ready for the next step.
Definitely. I totally agree with this. Yeah, because first of all, definition of scale up, speed up your growth, right? So M&A could be a very good tool for that because sometimes you're not that organized, but you can do the combination. You can organize a business combination with someone that is a bit more mature than you, right? And with some, let's say, complementary products to your company. So it's perfectly a way to scale up, right? To speed up your growth. Yeah, I definitely. So I think it's a set of skills that any or all entrepreneurs should be aware of it. You know, because, for example, if you have a startup company, one of the main challenges of a startup company is raising money. What is raising money? Raising money is a transaction with someone that is willing to bring money to your company. So if you do not know how this kind of process works, or if you do not know how to have the set of documents organized, or how to handle those conversations, the chances of failure are bigger. So then you might need more time to complete a transaction or to raise more money, And sometimes this time is critical for your survival,
So typically, let's say a startup, but not just startup, also scale-up. Scale-ups needs to raise funds, and they need to fund their development as well. What would be the key assets, the key checkboxes that investors or buyers, let's say, as in investors is more like the fund that's just putting money and expecting a return on investment, and the other one is more the other profile that you said, which is someone who's going to invest into something complementary that they can use to build up their own value, right? What would be the tick boxes that these types of investors would be looking for? If I get those boxes, I'm considering it.
Okay. I think we can see on several perspectives. Let's say on a perspective of a financial investor first. Okay, a financial investor when he's looking for, let's say, a company to invest, he's usually making a kind of a bet, but a bet on the entrepreneur. So the entrepreneur must be able to build trust since the beginning. And building trust is not that easy, because sometimes you can say something and then a few minutes later you say something a bit different. The investor might feel uncomfortable. So this is one thing. So building trust is absolutely critical. Second, on the perspective of financial investor, what they are looking for usually, they want to bring money, make the business grow, the faster the better, and then they must see a clear exit, right? Financial investor joins and exits.
So the money they make is not on the income that's coming every year on the dividends, it's on buying and in, out.
Yeah, in and out. Usually financial investors, they look like this. That's their, let's say, most usual approach. So, because how does it work in the real world? A financial investor, usually they raise money on their funds, let's say this way, with a group of investors, and they have a kind of a mandate
from like a VC.
Yes, or from institutional investors or from family offices. They raise money with these guys, and then they have 10 years, 15 years to return this money back to the investors. So entry and exit is mandatory because they have to return the money back. I'm talking about a kind of a private equity firms. They do like this. So having a clear view about the exit is absolutely critical for them, because they have to return the money to their investors also. That's why they require the exit. So it's really important for them to see that this company they are acquiring a position is really capable to grow really fast
and deliver
and become attractive for probably a strategic investors acquire later on, which is the exit of them.
Because it's always a question of getting bigger, so the bigger fish wants you, and then the bigger one. I had that discussion, it was pretty interesting actually, with a young entrepreneur back in Hong Kong, and she was building something. She was building a business, and it was a ladies' community kind of thing. And she was fighting for ladies, not rights in the community, but ladies' position in the community, right? So she built that network. And another lady came and said, hey, I like what you're doing, so I'm going to give you money to start up. So nothing was built already. She already had 100K. And she said, can you look at the contract? So I looked at the contract, and there was a clause in the contract that was saying, if in 5 years you haven't given me my money back, then either you have to close or the company is mine. And that entrepreneur was like, this is not fair. This is my company. And she wouldn't understand that point of having someone who's putting money in your company and therefore has a right to kill it or do whatever they want if you're not giving the money back. And the point was, she never thought in terms of, in 5 years, I have to get the money back. This investment is just an investment. They don't want their money back, right? Of course they do.
Yes, there is a clause that is very common on those contracts, which is the drag-along clause. Basically, it says that the investor have the ability to sell the company, or not to sell, to force the other shareholders to sell together with them based if certain conditions are met.
Or not met.
Or not met, exactly. So, yeah, this is a way that they use, to force a transaction if they need to exit, no matter if it is a profitable exit or not, but they must exit.
It's a loss-cutting kind of system.
Yeah.
How about the second type of investors then? So we talked about the financial ones, the other ones, the ones that invest into market position or something that's valuable to their own business. What would be the key criteria, the key check boxes that they want?
Usually, then it really depends on their approach. But for example, these auto parts transactions that are worked, these strategic investors, they were paying attention to two main reasons: market position, market share. So they were, looking for growth in the region, Brazil. And they were also looking for patents. And the company used to have...
so the IP.
Yes, IP, intellectual property rights within that region also. So this could be let's say, a driver for their decision-making process, So it really depends, but usually market share. Sometimes it is more related to products, right? Because or technology, because you can have a technology that could help them to raise entry barriers on the market or remove competition. So yeah, it really depends. And you should be a set of skills on the perspective of a business owners would be thinking about this. What could make my company attractive to strategic investors, right? Sometimes it's a matter of working on an intellectual property effort, Sometimes it's just a matter of having a big market. Sometimes it's just a matter of having products that are unique, right? And recognized by the clients as unique products. So yeah, it really depends.
I remember having a great business lesson just looking at a TV show that was about lawyers. And that episode was about a lady who was trying to convince a lawyer to help her with the building of her company, the building of the company. And no, the selling actually. And the lawyer was like, stop wasting my time. And the lady was like, why? I have a great idea. And he was like, yes, but that's the point. You have an idea, but you don't have the product. You don't have the IP. You don't have the brand. You don't have anything unique. So you don't have anything except an idea. So I'm not going to do anything until you can tick those boxes, come back at that time. That's what you're talking about.
Yeah. Yeah. Once I worked on a transaction, it was a winery business in Brazil, Brazil is not well known by this, but yeah, they have winery businesses in Brazil. And we were hired by a multinational to sell their businesses because they had acquired a big brand, and winery was not part of their core business anymore and decided to sell. Okay, then I started talking to the winemakers in Brazil, and I told them, look, if you buy this, you have a very strategic position compared to your competitors, because who owns such a big piece of land with, let's say, grapes planted there? Because to produce wine, once you do the plantation, it takes 4 or 5 years for you to harvest the first grape. So it takes a lot of time. And then I told them this, look, this is a very strategic asset. Okay, then I started collecting offers from them. Then it became difficult to compare those offers. Then I got back to my client and I told them, look, I think what you have to do is the following. Let's hire a lawyer. Let's write a contract. We put the contract on the table and we say, look, we will have a controlled auction process now. The one who changes this contract less and offer the higher value on this and this will get the business.
So M&A is actually not just financial engineering. It's also game and fun.
Yes.
Auctions.
Yes. It was a controlled auction. And I never forget, because this client, when we finished the transaction and they got the money and etc., they invited us for lunch, etc. And the CFO, he's a French guy, and he told me, look, we have to tell you something. We were expecting less than half of this for this transaction. You made an amazing job, blah, blah, blah. And then I was not aware of this. But anyways, depending on the way you structure, you can unlock a lot of value. That's why I always say, when you have a structured process, you can get a lot of benefits of this,
So if we wrap up on that point, what is it that buyers, I'm not saying investors, I'm saying buyers, what is it that they're looking for when they're looking at the potential transaction? If we summarize it, they're looking at, one, having the right person in front of them so they can trust. And two, they're looking at a logic that's turning the business into an asset. And then the asset is worth something. Is that a fair way to say it?
Yes, value creation is always on the table, on the back of their minds, and they are always looking for how are they going to make sure that value creation is secured. And this could be through a combination of several things, like having a very good team, like the good CEO that is going to run the business later on, or who is going to team up with their team. This is one thing. Second, growth perspectives, because then it will, let's say, help on speeding up the growth. They must deliver to their investors. Sometimes is a way of improving margins, adding products with higher margins, because value creation is always dependent on how much you make over time. So if you were implementing a transaction that will help you to improve your margins, at the end you will make money if you grow. And if you make more money, the company is more valuable, right? So value creation is secured. So that's the thing that is usually on the back of their minds.
If we turn it around, so same discussion, but from the opposite perspective. What are the deal killers? So we said the thing is a black box. You don't want to put your box where there might be a rat, right? So no rat around. Apart from that, let's say I'm an entrepreneur right now, which I am, but right, let's play a game. If there is this in my business, that's a business killer. If there is that in my business, that's a business killer. What would you say?
I think the main reason for transaction failure is the lack of trust.
Okay.
That's my opinion. Number one. And this, when a transaction fails, you can, if you investigate why it fails, probably someone lost credibility during the process. And it could be the company owner with the acquirer, the investor. It could be the lawyer with the company owner that they started to mismatch. Sometimes the lawyer and the investor, so it's really important to pay attention to this because we are all human beings. It's a matter of people, right? So this is really important. And so once this is okay, then you have to pay attention to details. So the numbers must be reliable over time. No matter if you are talking now or if you're talking 6 months later, the numbers should match. The number that you showed on the beginning should be exactly the same number that you showed later on. Otherwise, you can raise a red flag, right? Because the guy will say, well, why this number changed so much? So this is also a big deal breaker. Sometimes I see transactions not happening just because of that. And of course, in addition to that, having good, I think, advisors to help, because usually a transaction takes time.
Yeah, I was going to say, what's the amount of time? Is it like, usually it happens quick and fast over 2-3 months and then it's done? Or is it like the thing is going to last for 1.5 years, 2 years, 3 years, and that's to be expected? So it's not a problem. Just because it's long is not a problem.
Yeah, it depends. I would say for a startup companies, it could be more, let's say, straightforward and more a faster process, because sometimes a startup is just an idea, and then, it's just a bet. You have to check if the person is someone that you can trust, and that's it. But when you are talking about a company, right, with running operations, accounting statements, this kind of stuff, then it takes more time, because you have to double check if those, let's say, numbers are really reliable, blah, blah, blah. And then usually it can take from, 8 months to 2.5 years. The transaction in average 1.5 years, I would say, for companies. These auto parts took me 2.5 years to get to a completion phase. So it's a lot of work, Startup is usually way less than that.
Just out of curiosity, but your own business model as an M&A advisor is you take success fees, or you take a retainer in the beginning, or are you paid like just in the end if the thing happens? How is it working?
Yeah, usually we charge a retainer fee because we have to deploy some time, especially in the beginning on this, let's say, preparation phase, where we help company owners or entrepreneurs to decide about what type of transaction they are looking for. So, and this requires time, and we help them on this. Then we have time to deploy on the documentation also. So preparing the documents, all of that. And then we have some time deployed to start approaching investors. So we charge a retainer to cover those phases. And then once we start the conversation with investors, we have also a success fee based compensation if a transaction is completed. That's how it works normally.
All right. What's the cultural aspect? So you're a citizen of the world, right? You're Brazilian with one foot in here in Portugal, another one in Spain, a third one somewhere else, and you're always traveling between planes and trains and cars and all that. What are the cultural particularities that you see? And let's say someone says, okay, I want to sell my company, who should I sell it to? How do the Chinese think? How do the Portuguese think? How do the Spanish think? How do the Brazilians think? And how do you handle that kind of fog, cultural fog?
Yeah, I truly believe that it won't help without trust. That's the main thing that I always observe, because my work is helping people to reach agreements. So, I always introduce myself. I show pictures of my sons and this kind of stuff, which is very simple, and people might feel that it is privacy invasion. But in the real world, what I am trying to say, either with my clients or with potential investors, that I am a real person, and I'm just trying to help. No matter what happens, I will be transparent. I will be, trying to make to have a fair position. That's the thing, So sometimes I see people say, "Oh, I got a very good deal. I was very smart on this." Come on, we have to be fair, because if you do something that harms someone else at the end, maybe that's your last job, right? So
that's back to the trust thing.
Exactly, back to the trust. Trust is the critical thing, in my opinion.
But apart from that, from the cultural aspect, in Hong Kong things go fast, business, fast, business, fast. Here in Portugal, in Lisbon, it's a lot slower. People take time. How is it with the Spanish mindset and the Brazilian mindset? How do people think? How do you handle them?
Yeah, I got your question. Let me see, how can I answer this? Yeah, Chinese, for example, they what I learned is that, in the beginning, I thought that they were kind of lying all the time. But at the end, I realized that no, they were saying the same thing since the beginning. And yeah, that was the way. They were not used to contracts. This is a cultural aspect. So, since they were not used to the Occidental way of doing business using contracts, we should have a very strong position in communicating things clearly. And I remember that during that transactions, we had flip chart with thousands of things in written, just to make sure that what was agreed was fully understood for both parties, because they are, let's say, Chinese speakers. We were Portuguese speakers, and we were communicating in English. So we had to make sure all the time that the communication went pretty well. So this was something like this.
And it's true that the mentality with the Chinese is a lot about the contract. Let me say again, Western style, the contract is, we negotiated, the contract is the conclusion, and we agree on these terms, and this is the law of the transaction. It doesn't move. Whereas for the Chinese, it's the other way around. It's the contract is the basics that we agree on, but nobody is supposed to do nothing impossible. So whatever we agree on is just the beginning of it and the basics. And if it has to change, then it has to change, and we'll adapt. And that's one of the bumps that I've seen between Westerners and the Chinese. It's like the perception of the value of a contract is not the same.
Yes, exactly. Yes. So this is a clear cultural difference that we have, right? So we have to deal with that. And the faster you understand those differences, the better, right?
How about the Brazilian mindset? How do you, as a Brazilian, what is the specific element? Like, if you're talking to someone who's not Brazilian and they have to deal with a Brazilian, what is the thing they have to know?
Okay. Well, Brazilians are really, let's say, usually flexible, you know. So flexibility is one thing, social also. So we like the social part, you know, of building a relationship. So this is also really important. What else? Brazil is a very big country. So we have several differences depending on the region you are.
So inter-regional cultural
depending on the region that you are dealing with people, it's a different mindset, let's say this way. So you have to know about this, otherwise you cannot use just a single approach, you know. So I can tell you, for example, if I am going to do business in the south region of Brazil, my approach is different if I am going to do business in São Paulo or in the northeast region. So sometimes it's good for you to invite someone from that region to help you, you know, in the introductions, with the bases, with the conversations, you know, because in fact, the culture is different between those, let's say, regions. Because in fact, Brazil is like a continent. It's not like Europe, where you have, just to give you an example, Spain, that we have 45 million population. In Brazil, 220 million. So it's a lot more. Yeah.
What about mindset? Mindset is a topic that we keep bringing over and over in the Scale Up show, because I keep saying you can't scale your business and your operations unless you actually have the right way of thinking about it, right? So for instance, startup people are cash burners, so their job is to keep raising money and burning the money to keep increasing the market shares. But people who scale up their business are more about building the organization into assets and making something that can be sold to someone else without burning too much cash, right? So the approach is not the same. M&A wise, what is the right mindset when you want to scale? What is the right mindset when you want to get to the next step?
Yeah, in my opinion, you should be open-minded to ask for help, you know, because you improve the chances of being successful in this field if you have good people working with you. And not only advisors, you can have inside your team, you know, people that have a proven track record on this specific field. For example, if you know that you're going to establish an acquisition strategy inside your company, you must have, let's say, on the accounting department, on the financial department, someone that had previous experiences on this. Otherwise, it could be a blocker, a difficult situation to handle if you do not have the right people on the right place.
So it's a mindset of accepting that you don't have all the solutions on your own and you can't do anything unless you ask someone who has that information that you don't have.
Yeah. Being open-minded to ask for help and to choose the right people to assist you is critical. It's critical, in my opinion.
Is there anything in terms of taking risks? Typically, entrepreneurs, they don't like risk. They sound like risky people, but the reality is they don't like risk. They test everything and they take action when they feel like the risk is reduced to the maximum. What's the mindset as far as risk is concerned, risk management?
I don't know if I get your question exactly.
Is it more about planning, and if you want to avoid risk as part of an M&A transaction, you plan it ahead?
Yes.
You build it so that you reduce everything, and is it like like a financial approach or an entrepreneurial approach? That's a good point. More like a financial approach or an entrepreneurial one?
Yeah, I think planning is really important, and once you see what would be the your counterparty, you can plan even on a more detailed way, right? So if you're going to talk to financial guys, is one thing. If you're going to talk to strategic guys, is a different, let's say, approach. So once you know this, and you know this if you plan in advance, then you can definitely improve the chances of getting to a completion phase, right? Because you will, at the end, be reducing the risk of failure, right?
What's your next project? So you were telling me about the Wealth Alchemists. What's the idea behind that?
Yeah, the idea behind Wealth Alchemists is basically continue this work of helping company owners and entrepreneurs in the creation of value via M&A transactions. But we are also planning to add a set of additional services to the company, because what we've just discussed here, for example, having the numbers organized, having the preparation phase duly organized, all of that, sometimes you need someone to help. So we are planning to have additional pieces of services to offer.
As like partners, or like partners in your network, or things you can do yourself?
Partners in our company, handling projects like acting as CFOs, with a CFO as a service approach, board member as a service to help the entrepreneur, to help them to make good decisions. So yeah, this kind of stuff we are still kind of organizing to do, but yeah, that's something that we will come up to the market really soon.
Well, good luck with that.
Thank you.
Thank you very much for your time and insights. What would be the key takeaway, the conclusion?
Build trust. Do not forget that. Ask for help if you do not know how to handle those conversations, or hire people that could help you on this. And pay attention to what are the actions that you should take for value creation, because this should be your main, let's say, observation. You have to pay attention on this, because if value creation is something that you're paying attention, then you become attractive over time.
So value creation then.
Yeah.
All right. So thank you again for your time and expertise, and see you guys next time on the Scale Up Show. Don't forget to follow the channels, comment, and everything as usual. Cheers.
Cheers.